Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're digging into Academy Sports and Outdoors, ticker ASO. And honestly, this one's a real head-scratcher.
So let's just jump right in. On December 9th, Academy Sports dropped its Q3 earnings, and the market's reaction was, well, pretty wild. They actually missed on revenue, but despite that, the stock ripped over 8% higher on the day.
So that brings us to the big question, right? What gives? What did the market see that made them completely ignore a revenue miss? The whole story here is about the quality of the earnings, not the top-line number.
All right, first things first, let's break down those headline numbers and see exactly how they stacked up against what Wall Street was expecting.
Here's the scorecard. Adjusted EPS, or earnings per share, came in at $1.14, which beat the consensus by about 7 cents. That's the good news. But net sales landed at $1.38 billion, missing expectations by about 1.3%. So on the surface, a pretty mixed bag, right? But investors clearly decided that earnings beat was the real story.
And this is where it gets interesting. The market basically looked right past that revenue miss and zoomed in on two things that are absolutely critical for profitability: a huge jump in margins and a really positive shift in who their customers are.
Okay, so here's the kicker. Their gross margin expanded by a massive 170 basis points year over year, hitting 35.7%. Now, in this tough retail environment, that kind of margin growth is a huge green flag for investors.
And this wasn't just luck or some one-time thing. It was the result of some seriously disciplined work across the entire operation. We're talking higher merchandise margins, smarter management of their sales and promotions, and even a 30 basis point improvement on freight costs and a 20 basis point gain on shrink. Just solid execution.
And this right here, this illustrates the second part of the story perfectly. Academy is doing a fantastic job attracting higher-income shoppers. Households making over $100,000 a year now make up 40% of their sales. That signals a much more resilient consumer base, which is exactly what you want to see.
So you're probably asking, how are they pulling this off? Well, it all ties back to management's core strategies, which are not only working, but they seem to be gaining steam. The company is really firing on all cylinders with its three main growth initiatives. Their new stores are performing great, comping in the high single digits. Their e-commerce business is absolutely exploding, up over 22% in the quarter. And bringing in those premium brands like Nike and Jordan is paying off, driving really strong results.
You know, the CEO, Steve Lawrence, said it himself on the call. He basically emphasized that these strategic proof points are really hitting their stride and building some serious momentum for the business.
Okay, but a fair analysis means looking at both sides of the coin. We have to balance all this good news against some very real headwinds and what management is forecasting for the rest of the year.
So, looking at their updated guidance, management is kind of signaling some cautious confidence. They tightened up their full-year comp sales range, which is good, but they also raised their outlook for gross margin. To me, that's a clear signal that they feel they have a strong handle on operations.
But let's not get ahead of ourselves. The core business is still facing some real pressures. Let's be clear. Comparable sales were still negative, down almost a full percent. That was driven by a 4.1% drop in customer transactions. And get this, the ammunition category alone was a drag of about 130 basis points on those comps. So still some work to do.
All right, let's put it all together. Let's connect the dots, build out the final thesis, and make our call on ASO.
You know, the whole debate here really boils down to this. You have stellar strategic execution and margin control on one side, and on the other, you've got this tough macroeconomic backdrop that's still putting a lid on their top-line sales. The bull case is pretty straightforward. Bulls are going to point directly to that 170 basis point margin expansion, that 22% e-commerce growth, and the successful shift to a higher income customer. They'll argue this is proof of a real structural improvement in the business.
Now, the bears are going to come back and say, that's all great, but what about the top line? They'll argue that without a clear path back to positive same-store sales growth, the stock's upside is pretty limited, no matter how well they manage their margins.
So, after weighing everything, here's where we land. We're initiating coverage with the market perform rating and setting a $58 price target. This really reflects the high-quality execution we saw in the third quarter, but it's balanced against those ongoing macro risks to the sales number. This is not financial advice.